ADP's stock is up 60,000% since it's IPO'd. It's an absolute monster, and it's a sleeper company because nobody really looks at payroll processing. But this company operates in 140 countries and processes payroll for over 41 million people. It's an absolute beast that grows simply, seems to be cheap, and continues to knock out earnings. Let's take a deep dive and figure out if you bought the stock today, held it for 10 years, how much should you make? You ready? Let's get to work. Welcome to Rational Investing. My name is Cameron Stewart, CFA. Thank you for watching the channel. I greatly appreciate it. Hit the like, subscribe button, always helps me out. We're going to take a look at ADP this time. This is the advanced data processing payroll HR company. It's in 140 countries and processes payroll for over 41 million people. The stock has continued to perform well as it hits earnings targets, hits revenue targets, and the stock has performed well, as I said on the outset, over 60,000% return since the IPO. Now we're going to value the stock like we do all stocks here in this channel from a long-term perspective. You want to buy a company and hold it for 10 to 20 years. You are a partner in the business if you're buying stock. It is not something to trade. You buy it, put it on the shelf, and you read the annual report. That's what you do when you own stock. Now, what we're going to do is we're going to view this stock with 5 key attributes. Number 1, we want top-line revenue needs to grow. Number 2, earnings growth. Number 3, strong free cash flow. Number 4, low debt. And number 5, a well-priced stock. Those 5 key attributes are what we use to signal further due diligence in a company. You want to meet those 5 criteria. You'll find those 5 criteria in a lot of famous books like 100 Baggers or One Up on Wall Street. There's lots of books that reference these types of metrics that are very simple, clear, and if you look at them over a long term, you get a sense for a business that's carved out a moat for itself and a management team that can execute. Let's take a look a little deeply now into ADP. All right, behind me is a nice visual of ADP's revenue. You've got revenue about $7 billion in 2004, and it kind of bumps along at a nice 10% annual growth rate for a good 20 years as it continues to grow up north to $20 billion of revenue. It looks like revenue growth is coming down a little bit. It's coming down in that 6% range from the 12% earlier 20 years ago. And we're going to forecast out 5%. So we're going to continue to slow down the growth rate over time as it scales and see what that does to our forecast. But fundamentally, the last 20 years, from 2004 to 2022, it's continued to grow, and we want to see that. That's definitely checking a box for us. Next is the EBITDA or the EBITDA margin. Here, the same story here. You've got EBITDA margins of, say, 20%, which are strong margins. It's grown recently to 26%. We're going to keep them pretty high and flat at 28 over long term. And you can see that this tracking revenue, it's growing from, say, just shy of $2 billion in 2004 to just over $5 billion in 2023. It continues to click along. You want to see that. It's a great business that can do that over a 20-year period of time. Let's dive into the cash flow one-pager. So what is a one-pager? Well, you can check out my website, cashflowinvestingpro.com. We make one-pagers, the analysts there in the Cash Flow Club. It looks like this. It looks like this. It's a one-page summary that gives you 10 years of financial information, a 10-year forecast, and an IRR estimate for a stock. Let's take a look at the revenue of this company. So revenue in 2014, like I said earlier, $10 billion. It's grown to 10.9, 11.6, 12.3, 14.1, 14.6, 15, 16.5, and 18. Almost every single year there in the last decade, revenue has gone up. If I look as an average return over that 10-year frame, the revenue has grown at 6% annually. That's great. It's a great mid-single digit, just kind of machine that's knocking out revenue growth. Great job, team. EBITDA, enterprise level earnings, not earnings per share, but total earnings per share, enterprise level, is growing 10% annually over this time. So 2 billion, 2.2, 2.5, 2.8, 3, 3.4, 3.7, 3.9, 4.3, and $5.1 billion last year. That is growth every single year for the last decade as margins expand, as revenue grew. Great job, team. That's a 10% annual growth rate in earnings. Fantastic. Debt levels, basically flat here, 2.1 billion for half this decade. Then it went to 3.5. It's sitting at 3.5, which is a 6% long-term growth rate. But if earnings are growing at 10%, it can sustain that. That's nice to see. Excess cash, basically zero here. Market cap, $33.5 billion earlier in the decade in 2014. It grows and grows and grows to $90 billion last year. It's a 12% annual growth rate as earnings grow, and you get a little bit of market multiple expansion there. Enterprise value is basically the same because debt hasn't moved much and cash is zero. Debt levels, essentially zero here. They've got $3.5 billion of debt, but earnings are 5.1, so they can pay off the debt like that in less than 1 year. That's essentially zero in my book, 0.7%. So again, that means that we have a equity-like return but a bond-like collateral position. So you're in a stock here that's growing mid-single digits every single year for the last 10 years. We look 20 years, same thing. But they have very little debt, so you're protected like a bondholder and you have equity-like upside. We'd like to see that. Enterprise value to EBITDA, this is a relative value metric. No, EBITDA is not free cash. We'll get there in a second. But this does give us a relative value metric of, over time, how much people are willing to pay for the stock and what does it flow like. And you can see it's cheap as 16 times. It's been as high as, say, 21 times, 22 times. Right now, it's sitting around 18 times, which is a fair price to pay for a stock that's growing earnings at double digits. Barely, but it's double digits. Let's take a look at free cash flow. My favorite statement, your favorite statement. The cash flow is where they make their actual jack. Let's figure out how much jack they're making. Adjusted free cash flow, we take free cash from operations and we expense stock-based comp just as a precaution. It's not an actual cash cost, but I want to punch the companies that try to mask compensation in stock. So 1.7 billion, what they had in 2014, 1.8, 1.9, 2, 2.3, 2.5, 2.9, 2.9, 2.9, 3.9. A growth rate of 10% annually of free cash flow from operations, which matches the growth rate we saw in EBITDA down here. So the two statements are kind of moving in line, which is a great smell check for accounting. Great job, accounting team over at the ADP. CapEx, how much money do they have to put back in the business to keep the train running? So imagine you run the business for 12 months. You do payroll processing for 41 million people. You answer customer complaints. You do all that stuff. You pay the executives. You pay the rent. At the end of the day, 12 months of operation, you have $4 billion of cash sitting on the table. That is the result of the company's operations for 12 months. What do you then do with it? Well, you peel off a little bit to put back in the business. You always have to do that. That's this, CapEx, $200 million. So they made $4 billion, they put $200 million back, no big deal. That's a drop in the bucket. So now you've got $3.8 billion of cash. What do you do with it? Pay down debt? You don't really have to. They are under-levered right now. You don't have to. That means that $3.8 billion flows right through to you and me. That is what the stock is valued on, or should be valued on. So here's your $3.8 billion of free cash flow. My shares, they are gobbling up shares like they're going out of style. There's 483 million shares outstanding earlier in the decade. There's 476, 459, 450, 443, 438, 433, 428, 421, 416. Every single year here, they're taking out shares like it's a machine. Good for them. On average, that's a 2% annual rate of deletion of shares, which is very strong. We normally don't see 2%. 2, 3, 4%ers are very, very rare. Typically, it might be 1%, if at all. So that's great. That means that this cash flow of $3.8 billion flows through to the 416 million shares outstanding, leaving about $9 per share of free cash flow. This is what the stock is based on. It trades at 270, which is a 4.2% yield. A nice yield for a company that's growing at double digits, buying back shares, has no debt. Very interesting stock. Let's take a look, if we forecast this position, this stock, what it might return in 10 years. Okay, so here we go. We have two forecasts. We have EBITDA and I have free cash flow. We're going to look at both of them. We're going to average the two in the stock price to figure out what is like a smell check, kind of finger in the air stock price for 10 years, because nobody knows what the future is going to hold. But we can try to protect ourselves by doing a little risk-reward trade-off. So I've got a basically mid-single digit growth rate here, call it 5.5%. Remember, they grew 10% annual EBITDA over the last decade. I'm going to cut that in half and say, okay, you did that, great job, Rockstar, but you're not going to be able to expand margins higher than that. You're going to leave margins kind of at their peak, and I'm going to give you a lower growth over the long term as you scale. Okay, it's fair. So I'm targeting roughly $8.8 billion of EBITDA over the next decade. They were at 5.1 last year, so they have to add about $3 billion of EBITDA over the decade. Reasonable. 19 times EBITDA, it traded average 19 times in the last decade, so it's an average market multiple, and I get an enterprise value of $166 billion, less some debt plus some cash, basically the same market cap, $162 billion. Divide by shares outstanding, and I get a $391 price target out 10 years as a just rough guess. It's just math, numbers on the page kind of thing. Cash flow. Remember, we said we had $3.8 billion of jack that they make. Divide by the shares, I get a per share basis. I can take that, mirror the same forecast as EBITDA, and I get $15 out long term as a cash flow forecast for this business. I apply yield, 4% yield, and I get a stock price of $375. I average the two, and I get $383. That is a rough guess estimate. Nobody knows what the future holds. Finger in the air price for stock. Okay, what does that mean? I can buy as much stock as I want right now at $234 a share. I think long term, it's in the $380 range, ballpark out there. I'm going to get a cash flow yield here every single year. That's either a dividend, they're going to buy back stock, they're going to make acquisitions, they're going to do what they want, but it's my rightful cash, it's my pro rata ownership as a partner in this business. That's what I'm entitled to. This is my cash flow stream. That gives me an IRR of 10%. That means that this business, I'm making 10% annually on my money every year for a decade. Now, the Fed's rate right now is 5.5%. So you can make 5.5% on a risk-free bond, or I can make double that on a company that has very, very little debt, has a long track record of growing, and seems to be an integral part of the global economy, processing payroll for 41 million people. That seems really interesting. It's an interesting risk-reward basis on my part that I believe. And our growth rates here are half what they were before. So it's a very interesting company. Check out ADP. Love to understand your thoughts on it. Let me know a comment down below. Let's review the 5 key attributes. Number 1, top line revenue growth. Yes, it's growing mid-single digits. Number 2, enterprise level earnings, EBITDA. Yeah, it's growing at 10% historically. Strong free cash flow, absolutely. $3.8 billion of jack, that's amazing. Very little CapEx. Low debt's essentially 0.7% leverage. I like that a lot. And well priced, yeah, I think it's well priced. We're going to give this stock a good rating because it's basically a market return in a world where it's very hard to find stocks that are going to return a market-based return over the long term. I think in general, the stock market is pretty richly valued given some of the just underlying economic data that I'm seeing. But this is the review of ADP. I hope you enjoyed it. Hit the like button, subscribe. It really helps me out. I'm trying to grow the channel. Thank you very much for doing that. Throw me a comment down below for the old algorithm. If you like the material, that helps as well. If you want to learn more about this, right, my professional gig, I'm a CFO. I work for private equity companies. I do this as just a fun hobby, but I also teach people to do this on their own. If you want to join the Cash Flow Club as an analyst, you can work for me. I'll teach you how to do this. You can just email me in the description, my bio. If you want to do this on your own, I teach a course on how to build financial models, both as an investment banker. If you want to go into investment banking, you can take that course. Or if you want to build your own stock portfolio and be able to run numbers for your own companies and build forecasts, I do that as well. Last thing, you can also join the Cash Flow Club, where me and some analysts kick out reviews of stocks that we find very interesting. We do about 10, 15 stocks a month, things that we find interesting. I host a webinar where I talk through kind of the economics of landscape and kind of pick out some stocks that I think are kind of interesting, but it's always up to you to do the due diligence. Check out the website, cashflowinvestingpro.com. Thank you so much for the time. This is Rational Investing. My name is Cameron Stewart, CFA. I appreciate the time. Take care. Bye-bye.